The post-Civil War era, 1865 to 1879. The United States ended the war with a depreciated inconvertible greenback currency and a heavy burden of public debt. The first question on the monetary agenda was what to do about the greenbacks. A powerful group of industrialists, calling for continuation of greenbacks, opposing resumption, and, of course, any contraction of money to prepare for specie resumption, was headed by the Pennsylvania iron and steel manufacturers. The Pennsylvania ironmasters, who had been in the forefront of the organized protective tariff movement since its beginnings in 1820, were led here and instructed by their intellectual mentor, himself a Pennsylvania ironmaster, the elderly economist Henry C. Carey. Carey and his fellow iron manufacturers realized that during an inflation, since the foreign exchange market anticipates further inflation, domestic currency tends to depreciate faster than domestic prices are rising. A falling dollar and a rising price of gold, they realized, make domestic prices cheaper and imported prices higher, and hence function as a surrogate tariff. A cheap money, inflationist policy, then, could not only provide easy credit for manufacturing, it could also function as an extra tariff because of the depreciation of the dollar and the rise in the gold premium. Imbibers of the Carey gospel of high tariffs and soft money were a host of attendees at the famous, quote, Carey Vespers, evenings of discussion of economics and politics. Influential Carey disciples included economist and Pennsylvania ironmaster Stephen Cowell, Eber Ward, president of the Iron and Steel Association, John A. Williams, editor of the association's journal, Iron Age, Representative Daniel Morrell, Pennsylvania iron manufacturer, I. Smith Homans, Jr., editor of the Bankers magazine, and powerful U.S. Representative William D. Kelly of Pennsylvania, whose lifelong devotion to the interest of the ironmasters earned him the proud sobriquet, quote, Old Pig Iron. The Carey Circle also dominated the American Industrial League, which spread the Carey doctrines of protection and paper money. Influential allies in Congress, if not precisely Carey followers, were the radical leader, Representative Thaddeus Stevens, himself a Pennsylvania ironmaster, and Representative John A. Griswold, an ironmaster from New York. Also sympathetic to greenbacks were many manufacturers who desired cheap credit, gold speculators who were betting on higher gold prices, and railroads, which as heavy debtors to their bondholders, realized that inflation benefits debtors by cheapening the dollar, whereas it also tends to expropriate creditors by the same token. One of the influential Carey disciples, for example, was the leading railroad promoter, the Pennsylvanian Thomas A. Scott, leading entrepreneur of the Pennsylvania and the Texas and Pacific Railroads. One of the most flamboyant advocates of greenback inflation in the post-war era was the Wall Street stock speculator Richard Shell. In 1874, Shell became a member of Congress, where he proposed an outrageous pre-Keynesian scheme in the spirit of Keynes's later dictum that so long as money is spent, it doesn't matter what the money is spent on, be it pyramid building or digging holes in the ground. Shell seriously urged the federal government to dig a canal from New York to San Francisco, financed wholly by the issue of greenbacks. Shell's enthusiasm was perhaps matched only by that of the notorious railroad speculator and economic adventurer George Francis Train, who called repeatedly for immense issues of greenbacks. Train thundered in 1867, quote, Give us greenbacks, we say, and build cities, plant corn, open coal mines, control railways, launch ships, grow cotton, establish factories, open gold and silver mines, erect rolling mills, carry my resolution, and there is sunshine in the sky. End quote. The Panic of 1873 was a severe blow to many overbuilt railroads, and it was railroad men who led in calling for more greenbacks to stem the tide. Thomas Scott, Collis P. Huntington, leader of the Central Pacific Railroad, Russell Sage, and other railroad men joined in the call for greenbacks. So strong was their influence that the Louisville Courier-Journal, in April 1874, declared, quote, The strongest influence at work in Washington upon the currency proceeded from the railroads. The great inflationists, after all, are the great trunk railroads. End quote. The greenback problem after the Civil War was greatly complicated by the massive public debt that lay over the heads of the American people. A federal debt, which had tallied only $64.7 million in 1860, amounted to the huge amount of $2.32 billion in 1866. Many ex-Jacksonian Democrats, led by Senator George H. Pendleton of Ohio, began to agitate for further issue of greenbacks solely for the purpose of redeeming the principal of federal debts contracted in greenbacks during the war. In a sense, then, hard money hostility to both inflation and the public debt were now at odds. In a sense, the Pendletonians were motivated by a sense of poetic justice, of paying inflated debts in inflated paper. But in doing so, they lost sight of the broader hard money goal. This program confused the party struggles of the post-Civil War period. But ultimately, it is safe to say that the Democrats had a far greater proportion of congressmen devoted to hard money and to resumption than did the Republicans. Thus, Secretary of the Treasury Hugh McCullough's, quote, loan bill of March 1866, which provided for contraction of greenbacks in preparation for resumption of specie payments, was passed in the House by a Republican vote of 56 to 52 and a Democratic vote of 27 to 1. And in April 1874, the, quote, inflation bill, admittedly vetoed later by President Grant, which provided for expansion of greenbacks and of national banknotes, was passed in the House by a Republican vote of 105 to 64, while the Democrats voted against by the narrow margin of 35 to 37. In the meantime, despite repeated resolutions for resumption of specie payments in 1865 and 1869, the dominant Republican Party continued to do nothing for actual resumption. The Pendleton Plan was adopted by the Democrats in their 1868 platform, and the Republican victory in the presidential race that year was generally taken as a conclusive defeat for that idea. Finally, however, the Democratic sweep in the congressional elections of 1874 forced the Republicans into a semblance of unity on monetary matters, and, in the lame duck congressional session led by Senator John Sherman, they came up with the Resumption Act of January 1875. Despite the fact that the Resumption Act ultimately resulted in specie resumption, it was not considered a hard money victory by contemporaries. Sherman had forged a compromise between hard and soft money forces. It is true that the U.S. government was supposed to buy gold with government bonds to prepare for resumption on January 1, 1879. But this resumption was 4 years off, and Congress had expressed intent to resume several times before. And in the meantime, the soft money men were appeased by the fact that the bill immediately eliminated the $300 million limit on national banknotes, in a provision known as, quote, free banking. The only hard money compensation was an 80% pro rata contraction of greenbacks to partially offset any new national banknotes. The bulk of the opposition to the Resumption Act was by hard money congressmen who, in addition to pointing out its biased ambiguities, charged that the contracted greenbacks could be reissued instead of retired. Hard money forces throughout the country had an equally scornful view of the Resumption Act. In a few years, however, they rallied as resumption drew near. That the Republicans were generally less than enthusiastic about specie resumption was revealed by the Grant administration's reaction to the Supreme Court's decision in the first legal tender case. After the end of the war, the question of the constitutionality of legal tender came before the courts. We have seen that the California and Oregon courts decided irredeemable paper to be unconstitutional. In the large number of state court decisions on greenbacks before 1870, every Republican judge but one upheld their constitutionality, whereas every Democratic judge but two declared them unconstitutional. The greenback question reached the U.S. Supreme Court in 1867 and was decided in February 1870 in the case of Hepburn V. Griswold. The court held, by a vote of 5-3, with all the Democratic judges voting with the majority and the Republicans in the minority. Chief Justice Salmon P. Chase, who delivered the decision denouncing his own action as Secretary of the Treasury as unnecessary and unconstitutional, had swung back to the Democratic Party and had actually been a candidate for the presidential nomination at the 1868 convention. The Grant administration was upset by Hepburn v. Griswold, as were the railroads, who had accumulated a heavy long-term debt, which would now be payable in more valuable gold. As luck would have it, however, there were two vacancies on the court, one of which was created by the retirement of one of the majority judges. Grant appointed not only 2 Republican judges, but 2 railroad lawyers whose views on the subject were already known. The new 5-4 majority dutifully and quickly reconsidered the question and, in May 1871, reversed the previous court in the fateful decision of Knox v. Lee. From then on, paper money would be held consonant with the U.S. Constitution. The national banking system was ensconced after the Civil War. The number of banks, national banknotes, and deposits all pyramided upward, and after 1870, state banks began to boom as deposit-creating institutions. With lower requirements and fewer restrictions than the national banks, they could pyramid on top of national banks. The number of national banks increased from 1,294 in 1865 to 1,968 in 1873, while the number of state banks rose from 349 to 1,330 in the same period. Total state and national banknotes and deposits rose from $835 million in 1865 to $1.964 billion in 1873, an increase of 135.2%, or an increase of 16.9% per year. The following year, the supply of bank money leveled off as the Panic of 1873 struck and caused numerous bankruptcies. As a general overview of the national banking period, we can agree with Klein that, quote, the financial panics of 1873, 1884, 1893, and 1907 were in large part an outgrowth of reserve pyramiding and excessive deposit creation by reserve city and central reserve city banks. These panics were triggered by the currency drains that took place in periods of relative prosperity when banks were loaned up, end quote. And yet it must be pointed out that the total money supply, even merely the supply of bank money, did not increase after the panic, but merely leveled off. Orthodox economic historians have long complained about the, quote, Great Depression that is supposed to have struck the United States in the Panic of 1873 and lasted for an unprecedented 6 years until 1879. Much of this stagnation is supposed to have been caused by a monetary contraction leading to the resumption of specie payments in 1879. Yet what sort of depression is it which saw an extraordinarily large expansion of industry, of railroads, of physical output, of net national product, or real per capita income? As Friedman and Schwartz admit, the decade from 1869 to 1879 saw a 3% per annum increase in money national product, an outstanding real national product growth of 6.8% per year in this period, and a phenomenal rise of 4.5% per year in real product per capita. Even the alleged, quote, monetary contraction never took place, the money supply increasing by 2.7% per year in this period. From 1873 through 1878, before another spurt of monetary expansion, the total supply of bank money rose from $1.964 billion to $2.221 billion, a rise of 13.1%, or 2.6% per year. In short, a modest but definite rise, and scarcely a contraction. It should be clear, then, that the, quote, Great Depression of the 1870s is merely a myth. A myth brought about by misinterpretation of the fact that prices in general fell sharply during the entire period. Indeed, they fell from the end of the Civil War until 1879. Friedman and Schwartz estimated that prices in general fell from 1869 to 1879 by 3.8% per annum. Unfortunately, most historians and economists are conditioned to believe that steadily and sharply falling prices must result in depression. Hence their amazement at the obvious prosperity and economic growth during this era. For they have overlooked the fact that in the natural course of events, when government and the banking system do not increase the money supply very rapidly, free market capitalism will result in an increase of production and economic growth so great as to swamp the increase of money supply. Prices will fall, and the consequences will be not depression or stagnation, but prosperity, since costs are falling too, economic growth, and the spread of the increased living standards to all the consumers. Indeed, recent research has discovered that the analogous, quote, Great Depression in England in this period was also a myth, and due to a confusion between a contraction of prices and its alleged inevitable effect on a depression of prices, and its alleged inevitable effect on a depression of business activity. It might well be that the major effect of the Panic of 1873 was not to initiate a Great Depression, but to cause bankruptcies in overinflated banks and in railroads riding on the tide of vast government subsidy and bank speculation. In particular, we may note Jay Cooke, one of the creators of the national banking system and paladin of the public debt. In 1866, he favored contraction of the greenbacks and early resumption because he feared that inflation would destroy the value of government bonds. By the late 1860s, however, the House of Cooke was expanding everywhere, and in particular had gotten control of the new Northern Pacific Railroad. Northern Pacific had been the recipient of the biggest federal largesse to railroads during the 1860s, a land grant of no less than 47 million acres. Cooke sold Northern Pacific bonds as he had learned to sell government securities, hiring pamphleteers to write propaganda about the alleged Mediterranean climate of the Northwest. Many leading government officials and politicians were on the Cooke Northern Pacific payroll, including President Grant's private secretary, General Horace Porter. In 1869, Cooke expressed his monetary philosophy in keeping with his enlarged sphere of activity. Quote, "Why should this grand and glorious country be stunted and dwarfed, its activities chilled and its very lifeblood curdled by these miserable hard-coined theories, the musty theories of a bygone age? These men who are urging on premature resumption know nothing of the great growing West, which would grow twice as fast if it was not cramped for the means necessary to build railroads and improve farms and convey the produce to market." End quote. But in 1873, a remarkable example of poetic justice struck Jay Cooke. The overbuilt Northern Pacific was crumbling, and a Cooke government bond operation provided a failure. So the mighty House of Cooke, quote, "stunted and dwarfed by the market economy, crashed and went bankrupt, touching off the Panic of 1873. After the passing of the Resumption Act in 1875, the Republicans finally stumbled their way into resumption in 1879, fully 14 years after the end of the Civil War. The money supply did not contract in the late 1870s because the Republicans did not have the will to contract in order to pave the way for resumption. Resumption was finally achieved after substantial sales of U.S. bonds for gold in Europe by Secretary of the Treasury Sherman. Return to the gold standard in 1879 was almost blocked in the last 3 years before resumption by the emergence of a tremendous agitation, heavily in the West but also throughout the country, for the free coinage of silver. The United States mint ratios had been undervaluing silver since 1834. And in 1853, de facto gold monometallism was established because silver was so far undervalued as to drive fractional silver coins out of the country. Since 1853, the United States, while de jure on a bimetallic standard at 16-1, with the silver dollar still technically in circulation, though non-existent, was actually on a gold monometallic standard with lightweight subsidiary silver coins for fractional use. In 1872, it became apparent to a few knowledgeable men at the U.S. Treasury that silver, which had held at about 15.5-1 since the early 1860s, was about to suffer a huge decline in value. The major reason was the realization that European nations were shifting from a silver to a gold standard, thereby decreasing their demand for silver. A subsidiary reason was the discovery of silver mines in Nevada and other states in the West. Working rapidly, these Treasury men, along with Senator Sherman, slipped through Congress in February 1873 a seemingly innocuous bill which in effect discontinued the minting of any further silver dollars. This was followed by an act of June 1874, which completed the demonetization of silver by ending the legal tender quality of all silver dollars above the sum of $5. The timing was perfect, since it was in 1874 that the market value of silver fell to greater than 16-1 to gold for the first time. From then on, the market price of silver fell steadily, declining to nearly 18-1 in 1876, over 18-1 in 1879, and reaching the phenomenal level of 32-1 in 1894. In short, after 1874, silver was no longer undervalued but overvalued, and increasingly so in terms of gold at 16-1. Except for the acts of 1873 and 1874, labeled by the pro-silver forces as, quote, the crime of 1873, silver would have flowed into the United States, and the country would have been once again on a de facto monometallic silver standard. The champions of greenbacks, the champions of inflation, saw a, quote, hard money way to increase greatly the amount of American currency, the remonetization of a flood of new overvalued silver. The agitation was to remonetize silver by, quote, the free and unlimited coinage of silver at 16-1. It should be recognized that the Silverites had a case. The demonetization of silver was a, quote, crime in the sense that it was done shiftily, deceptively, by men who knew that they wanted to demonetize silver before it was too late and have silver replace gold. The case for gold over silver was a strong one, particularly in an era of rapidly falling value of silver, but it should have been made openly and honestly. The furtive method of demonetizing silver, the, quote, crime against silver, was in part responsible for the vehemence of the silver agitation for the remainder of the century. Ultimately, the administration was able to secure the resumption of payments in gold, but at the expense of submitting to the Bland-Allison Act of 1878, which mandated that the Treasury purchase $2 million to $4 million of silver per month from then on. It should be noted that this first silver agitation of the late 1870s, at least, cannot be considered an agrarian or a particularly Southern and Western movement. The silver agitation was broadly based throughout the nation, except in New England, and was, moreover, an urban movement. As Weinstein points out, quote, silver began as an urban movement, furthermore, not an agrarian crusade. Its original strongholds were the large towns and cities of the Midwest and the Middle Atlantic states, not the country's farming communities. The first batch of bimetallist leaders were a loosely knit collection of hard money newspaper editors, businessmen, academic reformers, bankers, and commercial groups. End quote. With the passage of the Silver Purchase Act of 1878, silver agitation died out in America, to spring up again in the 1890s. The Gold Standard Era with the National Banking System, 1879 to 1913. The record of 1879 to 1896 was very similar to the first stage of the alleged Great Depression from 1873 to 1879. Once again, we had a phenomenal expansion of American industry, production, and real output per head. Real reproducible, tangible wealth per capita rose at the decadal peak in American history in the 1880s at 3.8% per annum. Real net national product rose at the rate of 3.7% per year from 1879 to 1897, while per capita net national product increased by 1.5% per year. Once again, orthodox economic historians are bewildered, for there should have been a Great Depression, since prices fell at a rate of over 1% per year in this period. Just as in the previous period, the money supply grew, but not fast enough to overcome the great increases in productivity and the supply of products. The major difference in the two periods is that the money supply rose more rapidly from 1879 to 1897 by 6% per year, compared with the 2.7% per year in the earlier era. As a result, prices fell by less, by over 1% per annum, as contrasted to 3.8%. Total bank money, notes, and deposits rose from $2.45 billion to $6.06 billion in this period, a rise of 10.45% per annum, surely enough to satisfy all but the most ardent inflationists. For those who persist in associating a gold standard with deflation, it should be pointed out that price deflation in the gold standard 1879 to 1897 period was considerably less than price deflation from 1873 to 1879, when the United States was still on a fiat greenback standard. After specie resumption occurred successfully in 1879, the gold premium to greenbacks fell to par, and the appreciated greenback promoted confidence in the gold-backed dollar. More foreigners willing to hold dollars meant an inflow of gold into the United States and greater American exports. Some historians have attributed the boom of 1879 to 1882, culminating in a financial crisis in the latter year, to the inflow of gold coin to the U.S., which rose from $110.5 million in 1879 to $358.3 million in 1882. In a sense, this is true, but the boom would never have taken on considerable proportions without the pyramiding of the national banking system. the deposits of which increased from $2.149 billion in 1879 to $2.777 billion in 1882, a rise of 29.2% or 9.7% per annum. Wholesale prices were driven up from 90 in 1879 to 108 3 years later, a 22.5% increase, before resuming their long-run downward path. A financial panic in 1884, coming during a mild contraction after 1882, lowered the supply of bank money. Total banknotes and deposits dropped slightly, from $3.19 billion in 1883 to $3.15 billion. The panic was triggered by an overflow of gold abroad, as foreigners began to lose confidence in the willingness of the United States to remain on the gold standard. This understandable loss of confidence resulted from the inflationary sop to the pro-silver forces in the bland Allison Silver Purchase Act of 1878. The shift in treasury balances from gold to silver struck a disquieting note in foreign financial circles. Before examining the critical decade of the 1890s, it is well to point out in some detail the excellent record of the first decade after the return to gold, 1879 to 1889. America went off the gold standard in 1861 and remained off after the war's end. Arguments between hard money advocates who wanted to eliminate unbacked greenbacks and soft money men who wanted to increase them raged through the 1870s until the Grant administration decided in 1875 to resume redemption of paper dollars into gold at pre-war value on the first day of 1879. At the time, in 1875, greenbacks were trading at a discount of roughly 17% against the pre-war gold dollar. A combination of outright paper money deflation and an increase in official gold holdings enabled a return to gold 4 years later, which set the scene for a decade of tremendous economic growth. Economic record-keeping a century ago was not nearly as well developed as today, but a clear picture comes through nonetheless. The Encyclopedia of American Economic History calls the period under review, quote, one of the most expansive in American history. Capital investment was high, there was little unemployment, and the real costs of production declined rapidly. End quote. Prices, wages, and real wages. This is shown most graphically with a look at wages and prices during the decade before and after convertibility. While prices fell during the 1870s and 1880s, wages only fell during the Greenback period and rose from 1879 to 1889. The figures tell a remarkable story. Both consumer prices and nominal wages fell by about 30% during the last decade of greenbacks. But from 1879 to 1889, while prices kept falling, wages rose 23%. So real wages, after taking inflation, or the lack of it, into effect, soared. No decade before or since produced such a sustainable rise in real wages. Two possible exceptions are the periods 1909 to 1919, when the index rose from 99 to 140, and 1929 to 1939, when the index rose from 134 to 194. But during the first decade, real wages plummeted the next year to 129 in 1920 and did not reach 1919's level until 1934. And during the 1930s, real wages also soared for those fortunate enough to have jobs. In any event, the contrast to this past decade is astonishing. And while there are many reasons why real wages increase, 3 necessary conditions must be present. Foremost, an absence of sustained inflation. This contributes to the second condition, a rise in savings and capital formation. People will not save if they believe their money will be worth less in the future. Finally, technological advancement is obviously important, but it is not enough. The 1970s saw this third factor present, but the absence of the first two caused real wages to fall. Interest rates. Sidney Homer writes in his monumental History of Interest Rates, 2000 BC to the present, that, quote, during the last 2 decades of the 19th century, 1880 to 1900, long-term bond yields in the United States declined almost steadily. The nation entered its first period of low, long-term interest rates, end quote, finally experiencing the 3 to 3.5% long-term rates which had characterized Holland in the 17th century and Britain in the 18th and 19th. In short, the economic giants of their day. To gauge long-term rates of the day, it is best not to use the long-term government bonds we would use today as a measure. The National Banking Acts of 1863 to 1864 stipulated that these bonds had to be used to secure banknotes. This created such a demand for them that, as Homer says, quote, by the mid-1870s, it put government bond prices up to levels where their yields were far below acceptable rates of long-term interest, end quote. But the Commerce Department tracks the unadjusted index of yields of American railroad bonds. For 1878, the year before gold, the yield was 6.45%. For 1879, 5.98%, and 1889, 4.43%. We stress that with consumer prices about 7% lower in 1889 than they had been the decade before, the real rate of return by decade's end was well into double-digit range, a bonanza for savers and lenders. Short-term rates during the last century were considerably more skittish than long-term rates. But even here, the decennial averages of annual averages of both 3 to 6 month commercial paper rates and overnight call money during the 1880s declined from what it had been the previous decades. Average commercial paper rates fell from 6.46% for the decade of 1870 to 1879 to 5.14% for the decade of 1880 to 1889. Average call money rates fell from 5.73% for the decade of 1870 to 1879 to 3.98% for the decade of 1880 to 1889. A burst in productivity. By some measures, the 1880s was the most productive decade in our history. In their A Monetary History of the United States, 1867 to 1960, Professors Friedman and Schwartz quote R.W. Goldsmith on the subject. Quote, the highest decadal rate of growth of real reproducible, tangible wealth per head from 1805 to 1950, for periods of about 10 years, was apparently reached in the 80s with approximately 3.8%. End quote. The statistics give proof to this outpouring of new wealth. The average gross national product per capita in 1958 prices rose from $531 for the decade of 1869 to 1878 to $774 for the decade of 1879 to 1888 to $795 for the decade of 1889 to 1898. This dollar growth was occurring, remember, in the face of general price declines. The average gross domestic product in 1929 prices rose from $11.6 billion per year for the decade of 1869 to 1878 to $21.2 billion per year for the decade of 1879 to 1888. Gross domestic product almost doubled from the decade before, a far larger percentage jump decade on decade than any time since. Labor productivity increased as manufacturing output per man-hour rose from 14.7 in 1869 to 16.2 in 1879 to 20.5 in 1889. The 26.5% increase here ranks among the best in our history. Labor productivity reflects increased capital investment. Capital formation. From 1869 to 1879, the total number of business establishments barely rose, but the next decade saw a 39.4% increase. Nor surprisingly, a decade of falling prices, rising real income, and lucrative interest returns made for tremendous capital investment, ensuring future gains in productivity. There was a massive 500% decade-on-decade increase in the purchase of structures and equipment from 1880 to 1890, and this has never since been even closely rivaled. It stands in particular contrast to the virtual stagnation witnessed by the 1970s. Total private and public capital formation roughly doubled between the 1870s and 1880s. It has repeatedly been alleged that the late 19th century, the golden age of the gold standard in the United States, was a period especially harmful to farmers. The facts, however, tell a different story. While manufacturing in the 1880s grew more rapidly than did agriculture, the census of 1890, report Friedman and Schwartz, quote, was the first in which the net value added by manufacturing exceeded the value of agricultural output, end quote. Farmers had an excellent decade. The number of farms increased from approximately 4 million in 1880 to 4.5 million in 1890. Farmland increased from 536 billion acres in 1880 to 623 billion acres in 1890. Farm productivity increased from 5.1 persons supplied by a farm worker in 1880 to 5.6 in 1890. The value of farm gross output and product increased, in terms of 1910 to 1914 dollars, from $4.1 billion in 1880 to $4.99 billion in 1890. So farms, farmland, productivity, and production all increased in the 1880s, even while commodity prices were falling. And farm wage rates, even in nominal terms, rose during this time. In 1879 or 1880, the wage per month with room and board was $11.50. In 1889 or 1890, the wage per month with room and board was $13.50. This phenomenal economic growth during the decade immediately after the return to gold convertibility cannot be attributed solely to the gold standard. Indeed, all during this time, there was never a completely free market monetary system. The National Banking Acts of 1863 to 1864 had semi-cartelized the banking system. Only certain banks could issue money, but all other banks had to have accounts at these. The financial panics throughout the late 19th century were a result of the arbitrary credit creation powers of the banking system. While not as harmful as today's inflation mechanism, it was still a storm in an otherwise fairly healthy economic climate. The fateful decade of the 1890s saw the return of the agitation for free silver, which had lain dormant for a decade. The Republican Party intensified its longtime flirtation with inflation by passing the Sherman Silver Purchase Act of 1890, which roughly doubled the Treasury purchase requirement of silver. The Treasury was now mandated to buy 4.5 million ounces of silver per month. Furthermore, payment was to be made in a new issue of redeemable greenback currency, Treasury notes of 1890, which were to be a full legal tender, redeemable in either gold or silver at the discretion of the Treasury. Not only was this an increased commitment to silver, it was a significant step on the road to bimetallism, which, at the depreciated market rates, would mean inflationary silver monometallism. In the same year, the Republicans passed the High McKinley Tariff Act of 1890, which reaffirmed their commitment to high tariffs and soft money. Another unsettling inflationary move made in the same year was that the New York Sub-Treasury altered its long-standing practice of settling its clearinghouse balances in gold coin. Instead, in August 1890, it began using the old greenbacks and the new Treasury notes of 1890. As a result, these paper currencies largely replaced gold paid in customs receipts in New York. Uneasiness about the shift from gold to silver and the continuing free silver agitation caused foreigners to lose further confidence in the U.S. gold standard, and to cause a drop in capital imports and severe gold outflows from the country. This loss of confidence exerted contractionist pressure on the American economy, and reduced potential economic growth during the early 1890s. Fears about the American gold standard were intensified in March 1891, when the Treasury suddenly imposed a stiff fee on the export of gold bars taken from its vaults, so that most gold exported from then on was American gold coin rather than bars. A shock went through the financial community in the U.S. and abroad when the United States Senate passed a free silver coinage bill in July 1892. The fact that the bill went no further was not enough to restore confidence in the gold standard. Banks began to insert clauses in loans and mortgages requiring payment in gold coin. Clearly, the dollar was no longer trusted. Gold exports intensified in 1892, the Treasury's gold reserve declined, and a run ensued on the U.S. Treasury. In February 1893, the Treasury persuaded New York banks, which had drawn down $6 million on gold from the Treasury by presenting Treasury notes for redemption, to return the gold and reacquire the paper. This act of desperation was scarcely calculated to restore confidence in the paper dollar. The Treasury was paying the price for specie resumption without bothering to contract the paper notes in circulation. The gold standard was therefore inherently shaky, resting only on public confidence, and that was giving way under the silver agitation and under desperate acts by the Treasury. Poor Grover Cleveland, a hard-money Democrat, assumed the presidency in the middle of this monetary crisis. 2 months later, the stock market collapsed, and a month afterward, in June 1893, distrust of the fractional reserve banks led to massive bank runs and bank failures throughout the country. Once again, however, many banks, national and state, especially in the West and South, were allowed to suspend specie payments. The Panic of 1893 was on. In a few months, Eastern bank suspension occurred, beginning with New York City. The total money supply, gold coin, treasury paper, national banknotes, and national and state bank deposits fell by 6.3% in 1 year, from June 1892 to June 1893. Suspension of specie payments resulted in deposits, which were no longer immediately redeemable in cash, going to a discount in relation to currency during the month of August. As a result, deposits became less useful, and the public tried its best to intensify its exchange of deposits for currency. By the end of 1893, the panic was over, as foreign confidence rose with the Cleveland administration's successful repeal of the Sherman Silver Purchase Act in November of that year. Further silver agitation of 1895 endangered the Treasury's gold reserve, but heroic acts of the Treasury, including buying gold from a syndicate of bankers headed by J.P. Morgan and August Belmont, restored confidence in the continuance of the gold standard. The victory of the Free Silver Bryanite forces at the 1896 Democratic Convention caused further problems for gold, but the victory of the pro-gold Republicans put an end to the problem of domestic and foreign confidence in the gold standard. 1896. The transformation of the American party system. Orthodox economic historians attribute the triumph of William Jennings Bryan in the Democratic Convention of 1896 and his later renominations for president to a righteous rising up of the people demanding inflation over the interests holding out for gold. Friedman and Schwartz attribute the rise of Bryanism to a price contraction of the last 3 decades of the 19th century, and the triumph of gold and disappearance of the, quote, money issue to the price rise after 1896. This conventional analysis overlooks several problems. First, if Bryan represented the people versus the interests, why did Bryan lose, and lose soundly, not once, but 3 times? Why did gold triumph long before any price inflation became obvious? In fact, at the depths of price contraction in 1896. But the main neglect of the conventional analysis is the disregard of the highly illuminating insights provided in the past 15 years by the, quote, new political history of 19th century American politics and its political culture. The new political history began by going beyond national political issues, largely economic, and investigating state and local political contests. It also dug into the actual voting records of individual parishes, wards, and counties, and discovered how people voted and why they voted the way they did. The work of the new political history is truly interdisciplinary, for its methods range from sophisticated techniques for voting analysis to illuminating insights into American ethnic religious history. In the following pages, we shall present a summary of the findings of the new political history on the American party structure of the late 19th century and after, and on the transformation of 1896 in particular. First, the history of American political parties is one of successive, quote, party systems. Each party system lasts several decades, with each particular party having a certain central character. In many cases, the name of the party can remain the same, but its essential character can drastically change, in the so-called, quote, critical elections. In the 19th century, the nation's second party system, the Whigs versus Democrats, lasting from about 1832 to 1854, was succeeded by the third system, the Republicans versus Democrats, lasting from 1854 to 1896. Characteristic of both party systems was that each party was committed to a distinctive ideology clashing with the other, and these conflicting worldviews made for fierce and close contests. Elections were particularly hard fought. Interest was high since the parties offered a, quote, choice, not an echo, and so the turnout rate was remarkably high, often reaching 80 to 90% of eligible voters. More remarkably, candidates did not, as we are used to in the 20th century, fuzz their ideology during campaigns in order to appeal to a floating, ideologically different, independent voter. There were very few independent voters. The way to win elections, therefore, was to bring out your vote, and the way to do that was to intensify and strengthen your ideology during campaigns. Any fuzzing over would lead the Republican or Democratic constituents to stay home in disgust, and the election would be lost. Very rarely would there be a crossover to the other, hated party. One problem that strikes anyone interested in 19th century political history is, how come the average person exhibited such great and intense interest in such arcane economic topics as banking, gold and silver, and tariffs? Thousands of half-literate people wrote embattled tracts on these topics, and voters were intensely interested. Attributing the answer to inflation or depression to seemingly economic interests, as do Marxists and other economic determinists, simply won't do. The far greater depressions and inflations of the 20th century have not induced nearly as much mass interest in economics as did the milder economic crises of the past century. Only the findings of the new political historians have cleared up this puzzle. It turns out that the mass of the public was not necessarily interested in what the elites or national politicians were talking about. The most intense and direct interest of the voters was applied to local and state issues, and on these local levels the two parties waged an intense and furious political struggle that lasted from the 1830s to the 1890s. The beginning of the century-long struggle began with the profound transformation of American Protestantism in the 1830s. This transformation swept like wildfire across the northern states, particularly Yankee territory, during the 1830s, leaving the South virtually untouched. The transformation found particular root among Yankee culture with its aggressive and domineering spirit. This new Protestantism, called Pietism, was born in the fires of Charles Finney and the Great Revival movement of the 1830s. Its credo was roughly as follows: each individual is responsible for his own salvation, and it must come in an emotional moment of being, quote, born again. Each person can achieve salvation. Each person must do his best to save everyone else. This compulsion to save others was more than simple missionary work. It meant that one would go to hell unless he did his best to save others. But since each person is alone and facing the temptation to sin, this role can only be done by the use of the state. The role of the state was to stamp out sin and create a new Jerusalem on earth. The Pietists defined sin very broadly. In particular, the most important politically was, quote, demon rum, which clouded men's minds and therefore robbed them of their theological free will. In the 1830s, the evangelical Pietists launched a determined and indefatigable prohibitionist crusade on the state and local level that lasted a century. Second was any activity on Sunday except going to church, which led to a drive for Sabbatarian blue laws. Drinking on Sunday was of course a double sin, and hence was particularly heinous. Another vital thrust of the new Yankee Pietism was to try to extirpate Roman Catholicism, which robs communicants of their theological free will by subjecting them to the dictates of priests who are agents of the Vatican. If Roman Catholics could not be prohibited per se, their immigration could be slowed down or stopped. And since their adults were irrevocably steeped in sin, it became vital for crusading Pietists to try to establish public schools as compulsory forces for Protestantizing society, or, as the Pietists like to put it, to, quote, Christianize the Catholics. If the adults are hopeless, the children must be saved by the public school and compulsory attendance laws. Such was the political program of Yankee Pietism. Not all immigrants were scorned. British, Norwegian, or other immigrants who belonged to Pietist churches, whether nominally Calvinist or Lutheran or not, were welcomed as, quote, true Americans. The Northern Pietists found their home, almost to a man, first in the Whig Party, and then in the Republican Party. And they did so, too, among the Greenback and Populist parties, as we shall see further below. There came to this country during the century an increasing number of Catholic and Lutheran immigrants, especially from Ireland and Germany. The Catholics and High Lutherans, who have been called, quote, ritualists or liturgicals, had a very different kind of religious culture. Each person is not responsible for his own salvation directly. If he is to be saved, he joins the church and obeys its liturgy and sacraments. In a profound sense, then, the church is responsible for one's salvation, and there was no need for the state to stamp out temptation. These churches, then, especially the Lutheran, had a laissez-faire attitude toward the state and morality. Furthermore, their definitions of sin were not nearly as broad as the Pietists. Liquor is fine in moderation, and drinking beer with the family in beer parlors on Sunday after church was a cherished German tradition, Catholic and Lutheran. And parochial schools were vital in transmitting religious values to their children in a country where they were in a minority. Virtually to a man, Catholics and High Lutherans found their home during the 19th century in the Democratic Party. It is no wonder that the Republicans gloried in calling themselves throughout the period, quote, the party of great moral ideas, while the Democrats declared themselves to be, quote, the party of personal liberty. For nearly a century, the bemused liturgical Democrats fought a defensive struggle against people whom they considered pietist fanatics, constantly swooping down trying to outlaw their liquor, their Sunday beer parlors, and their parochial schools. How did all this relate to the economic issues of the day? Simply that the leaders of each party went to their voting constituents and raised their consciousness to get them vitally interested in national economic questions. Thus, the Republican leaders would go to their rank and file and say, just as we need big paternalistic government on the local and state level to stamp out sin and compel morality, so we need big government on the national level to increase everyone's purchasing power through inflation, keeping out cheap foreign goods through tariffs, or keeping out cheap foreign labor through immigration restrictions. And for their part, the Democratic leaders would go to their constituents and say, just as the Republican fanatics are trying to take away your liquor, your beer parlors, and your parochial schools, so the same people are trying to keep out cheap foreign goods through tariffs and trying to destroy the value of your savings through inflation. Paternalistic government on the federal level is just as evil as it is at home. So statism and libertarianism were expanded to other issues and other levels. Each side infused its economic issues with a moral fervor and passion stemming from deeply held religious values. The mystery of the passionate interest of Americans in economic issues in the epoch is solved. Both in the second and third party systems, however, the Whigs and then the Republicans had a grave problem. Partly because of demographics, greater immigration, and higher birth rates, the Democratic liturgicals were slowly but surely becoming the majority party in the country. The Democrats were split asunder by the slavery question in the 1840s and 1850s. But now, by 1890, the Republicans saw the handwriting on the wall. The Democratic victory in the congressional races in 1890, followed by the unprecedented landslide victory of Grover Cleveland carrying both houses of Congress in 1892, indicated to the Republicans that they were becoming doomed to be a permanent minority. To remedy the problem, the Republicans, in the early 1890s, led by Ohio Republicans William McKinley and Mark Hanna, launched a shrewd campaign of Reconstruction. In particular, in state after state, they ditched the prohibitionists, who were becoming an embarrassment and losing the Republicans large numbers of German Lutheran votes. Also, they modified their hostility to immigration. By the mid-1890s, the Republicans had moved rapidly toward the center, toward fuzzing over their political pietism. In the meanwhile, an upheaval was beginning to occur in the Democratic Party. The South, by now a one-party Democratic region, was having its own pietism transformed by the 1890s. Quiet pietists were now becoming evangelical, and Southern Protestant organizations began to call for prohibition. Then the new, sparsely settled mountain states, many of them with silver mines, were largely pietists. Moreover, a power vacuum, which would ordinarily have been temporary, had been created in the National Democratic Party. Poor Grover Cleveland, a hard-money laissez-faire Democrat, was blamed for the Panic of 1893, and many leading Cleveland Democrats lost their gubernatorial and senatorial posts in the 1894 elections. The Cleveland Democrats were temporarily weak, and the Southern Mountain Coalition was ready to hand. Seeing this opportunity, William Jennings Bryan and his Pietist coalition seized control of the Democratic Party at the momentous convention of 1896. The Democratic Party was never to be the same again. The Catholics, Lutherans, and laissez-faire Cleveland Democrats were in mortal shock. The, quote, party of our fathers was lost. The Republicans, who had been moderating their stance anyway, saw the opportunity of a lifetime. At the Republican convention, Representative Henry Cabot Lodge, representing the Morgans and the pro-gold standard Boston financial interests, told McKinley and Hanna, pledge yourself to the gold standard, the basic Cleveland economic issue, and drop your Silverite and Greenback tendencies, and we will all back you. Refuse, and we will support Bryan or a third party. McKinley struck the deal, and from then on, the Republicans, in 19th century terms, were a centrist party. Their principles were now high tariffs and the gold standard, and prohibition was quietly forgotten. What would the poor liturgicals do? Many of them stayed home in droves, and indeed the election of 1896 marks the beginning of the great slide downward in voter turnout rates that continues to the present day. Some of them, in anguish at the pietist, inflationist, and prohibitionist Bryanites, actually conquered their anguish and voted Republican for the first time in their lives. The Republicans, after all, had dropped the hated prohibitionists and adopted gold. The election of 1896 inaugurated the fourth-party system in America. From the third-party system of closely fought, seesawing races between a pious statist Republican Party versus a liturgical libertarian Democratic Party, the fourth-party system consisted of a majority centrist Republican Party against a minority pietist Democratic Party. After a few years, the Democrats lost their pietist nature, and they too became a centrist, though usually minority party, with a moderately statist ideology scarcely distinguishable from the Republicans. So went the fourth-party system until 1932. A charming anecdote, told to us by Richard Jensen, sums up much of the 1896 election. The heavily German city of Milwaukee had been mainly Democratic for years. The German Lutherans and Catholics in America were devoted, in particular, to the gold standard and were bitter enemies of inflation. The Democratic nomination for Congress in Milwaukee had been obtained by a populist Democrat, Richard Schilling. Sounding for all the world like modern monetarists or Keynesians, Schilling tried to explain to the assembled Germans of Milwaukee in a campaign speech that it didn't really matter what commodity was chosen as money, that, quote, gold, silver, copper, paper, sauerkraut, or sausages would do equally well as money. At that point, the German masses of Milwaukee laughed Schilling off the stage, and the shrewdly opportunistic Republicans adopted as their campaign slogan, Schilling and sauerkraut, and swept Milwaukee. The Greenbackers and later the pro-silver inflationist Bryanite Populist Party were not, quote, agrarian parties. They were collections of pietists aiming to stamp out personal and political sin. Thus, as Kleppner points out, quote, the Greenback Party was less an amalgamation of economic pressure groups than an ad hoc coalition of true believers, ideologues who launched their party as a quasi-religious movement that bore the indelible hallmark of a transfiguring faith, end quote. The Greenbackers perceived their movement as the, quote, religion of the master in motion among men, end quote. And the Populists described their 1890 free silver contest in Kansas not as a political campaign, but as, quote, a religious revival, a crusade, a Pentecost of politics in which a tongue of flame sat upon every man, and each spake as the Spirit gave him utterance, end quote. The people had, quote, heard the word and could preach the gospel of populism. It was no accident, we see now, that the Greenbackers almost invariably endorsed prohibition, compulsory public schooling, and crushing of parochial schools, or that populists in many states, quote, declared unequivocally for prohibition, or entered various forms of fusion with the Prohibition Party. The transformation of 1896 and the death of the third-party system meant the end of America's great laissez-faire, hard-money libertarian party. The Democratic Party was no longer the party of Jefferson, Jackson, and Cleveland. With no further political embodiment for laissez-faire in existence, and with both parties offering, quote, an echo, not a choice, public interest in politics steadily declined. A power vacuum was left in American politics for the new corporate statist ideology of progressivism, which swept both parties and created a short-lived progressive party in America after 1900. The progressive era of 1900 to 1918 fastened a welfare-warfare state on America, which has set the mold for the rest of the 20th century. Statism arrived after 1900, not because of inflation or deflation, but because a unique set of conditions had destroyed the Democrats as a laissez-faire party and left a power vacuum for the triumph of the new ideology of compulsory cartelization through a partnership of big government, business, unions, technocrats, and intellectuals.